Luca Pacioli was a wandering Franciscan monk and mathematician. He was a contemporary of Columbus and a friend and collaborator of Leonardo da Vinci's. His seminal work, Summa de Arithmetica, was published in 1494. It contained a section, Details of Accounting and Recording, that described the system used in Venice. This was 4 decades after Gutenberg's invention of movable type. Printing centers all over Europe allowed Pacioli's Summa to be translated, printed, and the ideas soon spread across the continent. In a way, the printing press was the equivalent in his time of the internet today, kind of at the bleeding edge of technology.
Professional accounting regulators would have us believe that accounting is complex. But the fundamentals are elegantly simple. In this series of 2 presentations, we'll review these fundamentals in about 30 minutes. First, we'll look at the who, what, when, where, and why of accounting. In the second, we'll briefly explain the how. Afterward, you won't be a professional accountant or competent bookkeeper. But you should have a better understanding of accounting fundamentals.
According to Wikipedia, Ha-Joon Chang is a South Korean institutional economist specializing in development economics. He has served as a consultant to the World Bank, the Asian Development Bank, and the European Investment Bank, as well as to Oxfam and various United Nations agencies. He is a fellow at the Washington Center for Economic and Policy Research. In addition, Chang serves on the advisory board of Academics Stand Against Poverty. At SBA Canada, we have included 2 of his mass-market ebooks as required reading in our professional program. We prefer books that are well-written, inexpensive, and available in both ebook and audiobook formats. Since our students mostly study remotely, we believe that it is better to give a choice of formats. In that way they can read at their own pace, or listen as though attending a lecture. Not only is our approach more flexible, our core books are usually better written, and often cost as little as 10% of most college-level textbooks.
According to Chang, economics is not alone in appearing to be more difficult to outsiders than it really is. In any profession that involves some technical competence, be it economics, plumbing, or medicine, jargons that facilitate communication within the profession make its communication with outsiders more difficult. A little more cynically, all technical professions have an incentive to make themselves look more complicated than they really are so that they can justify the high fees their members charge for their services.
In part 1 we looked at the origins of double-entry bookkeeping. The fundamental theory underlying accounting has not changed all that much in the 600 or so years since Italian merchants began using it in the latter part of the 13th century. At SBA Canada we believe that students should quickly dive into the fundamental accounting algorithm, which is elegantly simple. To use a Canadian analogy, double-entry bookkeeping is to accounting, like skating is to ice hockey. Except that for most of us, it's probably easier. The complexity in accounting derives mostly from taxation, technological innovation, and understanding human behavior, which are almost certainly best learned on the job.
Your instructors for this course include ChatGPT, a new artificial intelligence tool. We also used a little actual intelligence provided by Wikipedia and Investopedia, and internet search tools provided by both Microsoft and Google. The materials were assembled using Microsoft PowerPoint by Rob Farrow, a retired CPA and the executive director of SBA Canada.
Before we discuss how transactions are recorded, let's revisit the concept of a transaction. All physical things in our world are made up of molecules. In a sense, transactions are like the molecules of an accounting system. Our job as bookkeepers is to identify and to record the elements, or atoms, present in each transaction molecule. This is much easier than physics or chemistry since you don't need an electron microscope to see a transaction. Since a transaction involves an exchange, usually between 2 or more entities, you only need to listen to the entity you work for. The entity will tell you what is being exchanged and how much was paid or received. Usually, They will create a receipt or document for each party to describe what was exchanged.
In the Middle Ages, bookkeepers meticulously recorded each transaction in books. That's why we called them bookkeepers. In today's digital world, transactions involving money or credit cards are usually recorded automatically by banks or other financial institutions. Bookkeepers in small businesses today work a little differently. The bookkeeping function today is more like harvesting than recording. However, today's record keeping is just as critical, but perhaps a little more complex.
In theory, double-entry bookkeeping is elegantly simple. When recording transactions for an entity, there are only two rules. Each transaction involves at least two parts called accounts. By convention, we call these two parts debits and credits. 2. In any transaction, the sum of debits must equal the sum of credits. If the two rules are followed faithfully, something good happens when we produce financial statements from underlying transactions. The total assets the business entity owns will always equal the sum of liability and equity accounts. Accountants refer to this as the balance sheet equation.
Internalizing these two rules and the balance sheet equation is essential for anyone to understand accounting or bookkeeping properly.
In this presentation, we'll only discuss the two most common financial statements, the balance sheet and the income statement. The balance sheet presents a listing of all of the assets owned by a business. The liabilities represent borrowing or debt incurred in the course of business activities. The difference between assets and liabilities represents the shareholders' or owner's equity in the business assets. For its part, the income statement represents the operations of a business over a specific period. At the end of the financial year, the profit or loss for the year is close to owner's equity. After that, the income and expenses are reset to zero. This is referred to as the time period concept of accounting.
The word credit is now widely used in the English language. It has its origins in the practice of double-entry bookkeeping. While credit has positive connotations in the language, it has no such positive connotations in accounting. In accounting, credits and debits are merely counters or signs, like plus and minus. Unlike plus and minus, debits and credits can either increase or decrease depending on the context. In the accompanying guide, we have reproduced a discussion of the nature of debits generated by ChatGPT. By all means, read the overview. However, students must understand that debits and credits are merely counters in bookkeeping. General connotations in English, particularly regarding the term credit, are irrelevant in accounting theory. In other words, the idea that credits are good is not relevant. The overview also discusses the notion of T accounts. In the next slide, we'll illustrate how a T account is used in training. T accounts aren't used in bookkeeping. They are only used to train would-be bookkeepers how to analyze transactions, and by accounting students answering questions on accounting exams.
Most accounting courses teach students how to record each part of a transaction individually in T accounts. This mock-up of a ledger card represents a ledger card for the Canadian bank account. The two green lines form a T. Hence, this is referred to as a T account.
Another way to state the balance sheet equation is as follows. All of the assets of a business must either be purchased using debt or contributed by owners. When owners leave profits invested in the company, their equity in the business assets increases. Here we describe assets, liabilities, and equity in simple English. For most of us, the notion of profit is self-evident. In this slide, we show the balance sheet equation after profit is close to equity at the end of the year. To review these concepts, we treat you to a short YouTube video by a professional accountant from Ireland. Next, we provide you with a cheat sheet you can use until you've internalized the meaning of debits and credits. Debits increase assets and expenses. Credits increase liabilities, equities, and revenue. Or, if you prefer, we've provided a visual representation. In this presentation, we introduced several key accounting concepts. You must master all of these to become a skilled accounting technician.